On August 15th, 1971, Richard Nixon walked into a television studio and detonated the global financial order in 17 minutes. He didn't declare war. He didn't announce an invasion. He told the world that the United States would no longer exchange dollars for gold. Temporarily, of course. The word temporary has a specific meaning in politics. It means permanent. But we need you to stay calm for another 6 months. 55 years later, the gold window is still closed. The temporary measure became the foundation of the entire modern monetary system. Every dollar in your wallet, every treasury bond in your retirement account, every price on every shelf in every store on earth traces its logic back to that 17-minute broadcast. Nixon didn't just close a window, he opened a trapdoor, and the entire world has been standing on it ever since. But here's the part they never teach you. Nixon didn't close the gold window because he wanted to. He closed it because he had to. Because a foreign power was draining America's gold reserves so fast that continuing the exchange would have emptied Fort Knox within months. That foreign power was France. Charles de Gaulle had been sending warships to New York Harbor to collect French gold from the Federal Reserve vaults, literally loading bullion onto naval vessels and shipping it home. He understood something the American public didn't. The United States had printed far more dollars than it had gold to back them. The promise of $35 per ounce was a lie maintained by the collective agreement of nations not to test it. De Gaulle tested it. And when he did, Nixon had two choices: honor the promise and watch the gold disappear, or break the promise and keep the gold. He broke the promise. The rest of the world absorbed the consequences. American credibility took a wound it papered over with military power and petrodollar agreements. And the lesson was recorded by every nation with a finance ministry and a memory. Now, someone else has learned that lesson. Someone with 4,000 tons of gold, a manufacturing base that produces more than America and Europe combined, and a very specific plan for the moment the trapdoor opens again. China hasn't been hoarding gold by accident. The People's Bank of China has been accumulating gold at a pace that defies every public explanation offered by Beijing. Official reserves have surged past 2,300 tons. But official reserves are what China chooses to disclose. The actual number, tracked through import data, refinery output, Shanghai Gold Exchange withdrawals, and satellite analysis of vault construction, points to a figure closer to 4,000 tons, possibly higher. China mines more gold domestically than any other nation and exports almost none of it. Every ounce pulled from Chinese soil goes into Chinese vaults. State-owned commercial banks purchase gold on international markets through channels that don't report to the IMF. Sovereign wealth funds accumulate through intermediaries in Hong Kong and Singapore that obscure the ultimate buyer. The operation is the largest strategic resource acquisition since the United States built its own gold reserves in the 1930s and 1940s, and it's been running for over 15 years with an intensity that has accelerated sharply since 2022. The question everyone asks is why. The question almost nobody asks correctly is why now and why this much? Because the answer to those questions reveals something that should fundamentally change how you think about the dollar in your savings account. China is not buying gold because it's a good investment. Central banks don't think in terms of portfolio returns. They think in terms of strategic positioning. China is buying gold because it is building the architecture for a moment when it no longer needs the dollar. And gold is the only asset on Earth that functions as money without requiring any other nation's permission, cooperation, or infrastructure. Gold settles itself. It doesn't route through SWIFT. It doesn't clear through New York. It doesn't depend on a server that Washington can shut off with a phone call. 4,000 tons of gold is not a hedge. It's a foundation. The foundation for a monetary system that treats the dollar as optional. To understand what China is building, you have to understand what Nixon destroyed, and why the destruction created the vulnerability China is now exploiting. Before 1971, the global monetary system had a physical anchor. Dollars were convertible to gold at a fixed rate. This meant the United States couldn't print unlimited dollars, because every dollar represented a claim on a finite quantity of metal. The system imposed discipline. It constrained spending. It made fiscal recklessness immediately visible, because the gold reserves would shrink in proportion to the excess. Foreign nations held dollars, not out of trust, but out of contract. The gold backing was the contract. When Nixon voided that contract, the dollar became backed by nothing except the willingness of foreign governments to continue accepting it. That willingness rested on three pillars: American military dominance, the Petrodollar agreement with Saudi Arabia that required oil to be priced in dollars, and the sheer inertia of a system with no immediate alternative. China has spent 20 years systematically weakening all three pillars, with the patience of a civilization that thinks in centuries rather than election cycles. The military dominance pillar is being challenged not through direct confrontation, but through strategic area denial. China's naval expansion, its missile capabilities, its fortification of the South China Sea, none of these are designed to defeat the American military in open war. They're designed to raise the cost of American power projection to the point where it becomes economically irrational. An aircraft carrier that costs $13 billion can be neutralized by a hypersonic missile that costs a fraction of that. The math doesn't favor the carrier. And when the math doesn't favor the instrument of military dominance, the dominance itself becomes theoretical rather than practical. The petrodollar pillar cracked publicly when Saudi Arabia began accepting yuan for oil settlements. The agreement that had underpinned dollar demand since 1974, the deal that required every nation buying oil to first acquire dollars, is no longer exclusive. Russia sells oil to China in yuan. Iran sells oil to China in yuan. The Gulf states are conducting bilateral energy trades in currencies that don't touch the dollar system. Each barrel of oil sold outside the dollar removes 1 unit of structural demand for the currency your savings are denominated in. The inertia pillar, the argument that there's simply no alternative to the dollar, is being dismantled by infrastructure. The cross-border interbank payment system, CIPS, is China's alternative to SWIFT. It processes transactions in yuan between banks in over 100 countries. The digital yuan is being tested in cross-border settlement with multiple trading partners. The Shanghai Gold Exchange allows gold to be traded and priced in yuan, creating a parallel pricing mechanism to London and New York. The Belt and Road Initiative has created a network of nations whose economic infrastructure is physically connected to China rather than financially connected to the dollar. None of these individually replaces the dollar. Together, they create something more dangerous to dollar dominance than any single replacement currency could. They create optionality, the ability for nations to choose, and choice is what kills a monopoly. If you're beginning to understand why 4,000 tons of gold changes the calculus of global finance, hit that like button. This isn't about vanity metrics. It's about making sure this reaches the people who still think the dollar's position is unassailable, because no single currency can replace it. They're right that no single currency will replace it. They're wrong that this makes the dollar safe. The dollar doesn't need a successor to lose its dominance. It just needs the world to develop alternatives, and the alternatives are already built. Every like pushes this in front of someone who needs to understand what China's gold means before the implications arrive in their grocery bill. Now let me show you the 1971 parallel that keeps the smartest people in sovereign wealth funds awake at night. In 1971, France forced Nixon's hand by doing something simple. It demanded the gold it was owed. It exchanged paper claims for physical metal. It moved down the pyramid from promises to reality. The system couldn't survive the conversion because there wasn't enough gold to honor all the claims simultaneously. The United States defaulted on its gold obligations and rebranded the default as policy. China is running the same play in reverse. Instead of demanding gold from America, it's accumulating gold independently, building reserves so large that it can credibly anchor a competing monetary framework. China doesn't need to walk into the Federal Reserve and demand conversion. It doesn't need a confrontation. It needs a critical mass of gold that allows it to say credibly to every trading partner on Earth, "Our currency is partially backed by 4,000 tons of gold sitting in vaults on sovereign Chinese soil, and the dollar is backed by $36 trillion in debt. Choose." That choice offered at the right moment, during a financial crisis, during a bond market dislocation, during the next round of sanctions that freezes another nation's reserves. That choice is the modern equivalent of de Gaulle's warships in New York Harbor. It doesn't require a single shot. It just requires the gold to be there and the alternative infrastructure to be operational. Both conditions are being met right now. The timing reveals the strategy. China's gold accumulation accelerated dramatically after 2022. The same year, the United States froze Russia's $300 billion in central bank reserves. That freeze was meant to punish Russia. What it actually did was provide China with the most compelling argument for de-dollarization that any nation could ask for. Beijing didn't need to make a speech. It just pointed at Moscow's frozen accounts and said to every finance ministry in the developing world, that could be you. The gold buying that followed wasn't reactive. It was the execution of a plan that had been waiting for the right catalyst. Washington provided the catalyst and doesn't appear to understand what it triggered. Think about the strategic logic from Beijing's perspective. You are the world's largest trading nation. You run surpluses with virtually every major economy. Those surpluses generate enormous dollar inflows. For decades, you recycled those dollars into U.S. Treasury bonds, lending your surplus back to America. But you've now watched Washington weaponize that exact mechanism against Russia. You've watched your own Treasury holdings lose real value as the dollar's purchasing power declines. You've watched America add $1 trillion in new debt every 100 days, diluting the value of every bond you hold. And you've watched the Federal Reserve print more money in a single year than it created in the previous century. Every rational incentive points in one direction: convert the paper into something Washington cannot freeze, devalue, or print into meaninglessness. Convert it into gold. The decline in Chinese Treasury holdings from 1.27 trillion to below 760 billion is not a trade dispute. It's a strategic withdrawal. China is selling the paper and buying the metal. It's converting American IOUs into an asset that has survived every monetary system collapse in 5,000 years of recorded history. The money flowing out of treasuries isn't disappearing. It's changing form, from a claim on a debtor to a claim on reality. The scale of this repositioning is what makes it historically significant. 4,000 tons of gold, at current prices, represents over $300 billion in metal. But the strategic value exceeds the market value by orders of magnitude. Because 4,000 tons doesn't just give China a reserve buffer. It gives China the ability to partially back the yuan with gold at a moment of its choosing. Not a full gold standard, not convertibility in the classical sense, just enough gold backing to make the yuan credibly harder than the dollar in a crisis. In a world where the dollar is backed by nothing but debt, and the yuan is backed by even a fractional gold reserve, the comparative advantage shifts. Not permanently, not completely, but enough. Enough to accelerate the de-dollarization that is already underway. Enough to give every nation sitting on dollar reserves a reason to diversify faster. And here's what makes the parallel to 1971 so precise: it borders on rehearsal. Nixon's default happened not during peacetime calm, but during a moment of financial stress. The Vietnam War was draining the treasury. Inflation was rising. Confidence in the dollar was eroding. The gold demands from France were the trigger, but the underlying condition was fiscal excess, that it made the gold promise unsustainable. The United States today has fiscal excess that makes 1971 look like a rounding error. 36 trillion in debt. Annual deficits exceeding 2 trillion. Interest payments consuming more than the defense budget. A money supply that expanded 40% in 4 years. The underlying condition is identical. The only missing element is the trigger. China's gold hoard is the trigger in waiting. Not because China will demand gold from America, because China will offer the world something America can no longer provide: a monetary anchor that isn't made of debt. The moment that offer becomes credible, and 4,000 tons of gold is what makes it credible, the demand for dollars as reserves begins to decline, not at the margins, but at the core. And when reserve demand declines, the $36 trillion in debt that only functions because the world needs dollars becomes $36 trillion in debt that the world is trying to exit. That's not a recession. That's a monetary phase transition. The same kind Nixon triggered in 1971. Except this time, America isn't the one closing the gold window. America is the one standing outside it. Subscribe to this channel now, because this is not a future scenario. It's a current operation. Every quarter the numbers update. Every month the gold flows are tracked. Every bilateral trade agreement signed in yuan is another brick in the wall that China is building between the dollar and the future of global commerce. We're covering this transition in real time, before the financial media acknowledges it was happening. Turn on notifications, because the next video reveals the 3 specific events that could force this transition from gradual to sudden, and the historical precedent shows that sudden is exactly how these things resolve. The American public has been trained to think of the dollar the way the British public thought of the pound in 1950, as permanent, as inevitable, as the natural order of things. The British learned otherwise over the following 2 decades. The transition wasn't dramatic enough to make the evening news on any given day, but it was relentless enough to transform a global empire into a mid-sized economy struggling to afford its own healthcare system within a single generation. The dollar's trajectory is not set by American confidence. It's set by foreign calculations. And the largest, most methodical, most strategically deliberate calculation happening on Earth right now is being conducted in Beijing, measured in tons of gold, and aimed at a future where the dollar is one currency among several, rather than the currency above all others. China didn't announce this strategy. It doesn't need to. The gold speaks for itself. 4,000 tons is not a hedge against uncertainty. It's preparation for a specific outcome. The same outcome that France forced in 1971. The moment when paper promises collide with physical reality and reality wins. Nixon chose the dollar over the gold promise because the alternative was watching America's reserves drain to zero. The next version of that choice won't be made in Washington. It will be made by every nation on Earth, simultaneously, when they're offered a credible alternative to holding their savings in the currency of a nation $36 trillion in debt. China is building that alternative, ton by ton, vault by vault, trade agreement by trade agreement. And by the time it's announced, it will already be finished. Drop a comment below and tell me what you think China's endgame is. Is it a gold-backed digital yuan, a BRICS settlement currency with gold reserves, or simply the slow strangulation of dollar demand until the treasury market can no longer function at current rates? Tell me what you see, because the people who identified Nixon's default before it happened had months to prepare. The people who identified it after had decades of lost purchasing power to absorb. The gold is already in the vaults. The infrastructure is already operational. The only thing still missing is the moment. And moments like this don't send invitations. They send consequences.